Good evening, everyone. Thank you all for joining us. We're going to get started right away. We appreciate that you're spending some of your evening with us, so we want to be mindful of the time. We're going to be talking tonight about how to keep the IRS out of your back pocket, all the things that you need to know to make sure that you're getting the best tax benefits and protecting yourself from an audit. So if you have any questions, we would like you to type those into the Q&A box, and then we'll answer questions at the end of the presentation tonight. We're going to start off by having Nicole speak. Nicole has been doing taxes here in the Temecula Valley for 21 years. She is an enrolled agent as well as a certified tax coach. Thanks to mentorship and coaching from some of the nation's top business leaders, Nicole has excelled in her industry. She's our senior tax advisor here at Elite Tax Partners, and she enjoys helping business owners create tax and financial strategies to improve their business processes and their profitability. Along with her team, Nicole enjoys hosting Financial Peace University and is endorsed by Dave Ramsey as Temecula Valley's #1 tax expert. Take it away, Nicole.
Great. Thank you, Kelly. Thank you guys for joining us this evening. We are going to be covering a few things. The first one, the 87,000 IRS agents that have been hired and or are being hired right now. And that means for us small business owners, increased audits. So we're also going to be sharing with you how to audit proof your tax returns and how to keep your records. It's time to cross our T's and dot our I's. We're going to be explaining the new tax reform to you and showing you how you can benefit from this, saving most taxpayers thousands of dollars just by implementing one or two of the strategies we are going to share with you today. And then we will end it with Rob bringing it home and talking a quick overview on retirement planning in California. If you're a California business owner, the new Cal Savers program that was rolled out. All right, so this summer 2022, the IRS rolled out the Inflation Reduction Act. We're not really sure how it reduces inflation if you read through it, but anyhow, that's what they titled it. And we have a picture on the left-hand side of the screen. This is what our nerdy IRS agents look like beforehand and then after. So the IRS has come out and they are in the process of hiring 87,000 new agents. That's 87,000, not 8,700. What that means is increased audits. So they've told us that they are going to be auditing taxpayers who make $400,000 or more on their tax return. We, as tax preparers, know that that is not accurate. And here's the reason why. Is IRS agents, when they're very brand new and green, they go out on what's called field audits. They audit small business taxpayers. And usually it's taxpayers making under $150,000 a year. And they do that for a few reasons. One, because their IRS agents are green and they don't know what they're doing. They just graduated school, so they know what by the book is, but they don't really understand how it applies to the real world. So if you get audited as a small business owner, you have to pay your accountant, or you should pay your accountant to represent you in the audit. You never want to represent yourself in an audit. That's a huge mistake. So your accountant then is being paid by the client to train the new IRS agents on how to handle an audit. And so continuously we're bringing them back IRS code and showing them why our taxpayers are able to write off the write-offs that they have on the tax return. But normally taxpayers haven't done a great job at documentation. And so the IRS agent does find one or two small things costing the taxpayer $3,000, $4,000, $5,000, something like that. And then not only do they get training free from us that the client has paid for, they also now get $3,000 to $4,000 or $5,000 from the taxpayer that reimburses the IRS for the auditor's time. So that's where they start, is in the field auditing us small business owners. All right, with that, I'm going to introduce Kelly. Kelly, many of you have already met Kelly in our office. She's been preparing tax returns for over 19 years, completing thousands of them. Recently, she just passed the IRS Special Enrollment Exam Series, and she's now an enrolled agent. Congratulations, Kelly. Kelly enjoys partnering with her clients to understand their tax returns and to plan specific tax goals. She believes that through working together on a tax plan, tax time can be less frustrating and hold fewer unpleasant surprises for our clients. So with that, I'm going to turn it over to Kelly.
Hello again, everyone. The first thing I'm going to talk about is probably one of the biggest questions we get, and it is, what exactly can I write off on my tax return? Unfortunately, there is not a master list that exists anywhere that says these are your allowed write-offs, these are not allowed. If you ask the IRS, what they're going to respond with is that you can write off any expense that is ordinary and necessary for your business. So to the IRS, ordinary means that it's common. It occurs frequently in your industry. Necessary means that it's needed to either maintain or expand your business. Some examples we've come across in our time preparing taxes. A allowable example is the cost of holiday gifts and cards that you send to your customers. A lot of business owners do that, so it's ordinary, and it is necessary because it maintains engagement with your clients and keeps them coming back to you. An example on the other side of that, an insurance agent who wanted to purchase or deduct the cost of a gun that he bought because he felt it was necessary in visiting clients in the evening in their homes. The IRS ruled that that was not ordinary or necessary in his business. Now, if we flip this example, there are times that a deduction might not be allowed in one industry, but could be allowed in another industry. So if this taxpayer was an armed security guard running his own business, then the cost of a gun would be ordinary and necessary. So what is a write-off can change from tax return to tax return. Some things that don't change, there are some things that are absolutely not allowed as write-offs. The IRS says that lobbying expenses and political contributions are not allowed. Fines and penalties, so speeding tickets, parking tickets, even if you are on your way to a business event, are never deductible. Illegal payments, such as kickbacks, those are not allowed either. Another example of an illegal payment, this is a real story. One business owner decided that he wanted out of his business. He owned his own building. He hired an arsonist to burn it down for the insurance money. He was successful in claiming the insurance payout, but when it came time to do his taxes, he decided to write off that expense of paying the arsonist, and the IRS ended up questioning that. So not only did he have that expense disallowed on his tax return, but it turned into a whole lot of legal trouble. Now, documentation. Documentation is your most important job when it comes to protecting your tax return as we prepare it. You need to be able to prove any item on that tax return to the IRS if they were to come in and ask you. So one of the most important things you can do is keep a calendar. The calendar in your phone is a very powerful tool to make this work. So every time you have a business appointment, add some notes to your calendar. With the technology as it is today, you can talk into your phone and it transcribes it for you. Talk about who you talked to in that meeting, or if it was a meal, who you ate with, what you discussed, how it's going to benefit your business. Those are the things the IRS is going to want to see. If you're traveling for business, you need to save your email confirmation, receipts from your hotel, the admission for the conference you're going to, the tickets for your flights, all of that needs to be kept. So if you're receiving your receipts electronically, make a folder in your email to put those in so that they're all in one place if you need to look for them. Vehicle expenses. We're going to talk about this a little bit more in a few minutes, but a mileage log is necessary. No matter what method that you're using to write off your vehicle expenses, you have to have a mileage log. Most audited items. So meals, miles, and travel are really the top three. The IRS frequently will send out an audit letter for those three specific categories. They're going to ask you to provide your meal receipts, your mile documentation, and your travel documentation. If you cannot provide those three things, then they're going to start looking harder. They're going to think to themselves, if they're not documenting these things, then what else on their return is there that they don't have documentation for? We have actually seen a meals, miles, travel audit turn into a complete 5-year audit of an entire business. So they're not messing around. And when we tell you to keep those receipts, we really mean it. Now, meals normally have been a 50% deduction in the past. There's a special COVID rule in place. It was in place for 2021 as well as 2022 that allows us to write off 100% of your meal expense as long as those meals were purchased from a restaurant. So it can be something you brought into the office or ate at the restaurant. That deduction is going to go back down for 2023. Now, vehicle expenses. So like I said earlier, you have to keep your mileage log. There are apps out there to do that for you. There's one that we recommend. It's called Mile IQ. So Mile IQ is a stalker. It follows you everywhere you go. It knows every trip that you take. So at the end of the week, I would say at least weekly, you get to go into your Mile IQ and you get to swipe like you're in an online dating app. So you swipe left to say business, right to say personal, and it creates a mileage log for you. So it's automating all of the hard work. Then at the end of the year, we're going to use that mileage log to help establish what your vehicle expense deduction is. So there's two different ways that you can do vehicle expenses: actual cost or the standard mileage rate. So actual cost means that you have to document all of your expenses for that car for the whole year. So all of your insurance, your car repairs, your, AAA, gas receipts, everything needs to be totaled. And then whatever percentage your mileage log says that you use that car for business, that's the percentage that you're going to get to write off on your tax return. So if it was $10,000 of expenses, 90% business use, your deduction is going to be $9,000. Now, when you turn your profit and loss statement into us at the end of the year, for those of you on QuickBooks, you'll need to make that adjustment inside QuickBooks, because whatever shows up on your profit and loss statement is what we're going to put on your tax return. So you need to make an adjustment for the non-deductible personal portion of that. Now, if you're using the standard mileage rate, we're going to take the total business miles off your mileage log, and we're going to subtract or multiply it by the mileage rate. So this year, the mileage rate did increase and increased again halfway through the year because of the increase in gas prices. So we will need to know your mileage totals for the first half and the second half of the year. Now, entertainment expenses. This used to be an allowed write-off, and a lot of people don't realize that it's not being allowed any longer. Starting with the Tax Cuts and Jobs Act back in 2018, it was disallowed. So it should be coming back when that expires after 2025, but who knows what will happen between now and then. So entertainment expenses, like taking someone to a football game, the price of the tickets is not deductible. Now, if you have food and drinks while you're there, you can still write that off as a business meal. You're still going to have to document the business purpose, who you were with, what you talked about. But as long as you have an itemized receipt that shows what the meal expenses were, you can write off that portion. Now, what about your office Christmas party? Is that considered entertainment? No, we would say that's considered team building. So if you have a team building event, then that is deductible because it does benefit your business. Now, client appreciation, if you were to have a client Christmas party, we would call that a client appreciation expense because you're investing in keeping your clients engaged with your business to continue their relationship with you. So now I'm going to turn it over to Nicole and let her talk a little bit more about audit risk.
All right, we're going to cover travel again. we're gonna, so to deduct travel, just to jump into this a little bit more, there's 4 tests to deduct travel. You have to have a business purpose. So is it a client meeting, a conference, a research and development, a board meeting? Is it ordinary? Is it typical in your line of business? Kelly already covered what ordinary means. She also covered what necessary means. Does it help you increase profit or does it expand your business? And then she covered the documentation for travel. So let me give you an example. So Kelly and I are in the business of preparing taxes, and it is mandated every single year that we do a whole bunch of continuing education. Let's say Kelly and I find a conference for education in Hawaii for 3 days. So Kelly and I the business purpose is a conference for continuing education. It is ordinary in the course of my business because continuing education is mandated, and it is necessary to help us expand our business, giving us more knowledge to provide for our clients. So the documentation I need, Kelly already covered that on a previous slide, but my calendar needs to be filled in. And I also need to have all my receipts for my hotel, my flight, everything like that. Now, if I decide to extend the trip for myself, my fiance, and my son from 3 days and maybe stay there because I'm already in Hawaii for 2 weeks, my son and my fiance are not on payroll, so I cannot deduct their flight tickets. And then after 3 days, I can no longer deduct any of my hotel or meals at all because now it is a personal trip. So for 3 days, I can deduct the hotel and meals while I'm at the conference, and I can deduct my airfare there and back as travel. All right, next we're going to go on to Amazon. And Amazon is what we've seen get really sloppy with clients. I see a ton of Amazon charges. And they're all listed as office supply. And so what we want to talk about, we're going to be talking about commingling and why we don't want to do that. But we want to definitely have 2 different Amazon Prime accounts. And you can actually set one up for your business and not pay the extra membership. It's just a separate login. And so we are highly encouraging our clients to do this because Amazon is one that we've seen they want to see it. And if you have to print out the entire Amazon for the entire year and it's very commingled with your family members and everything, that's going to get really messy. So with that, we're encouraging 2 separate logins. And then also we want to make sure that we are titling things properly in Amazon. So if it's a gift, you're titling it as a gift. And now I'm even going so far as to writing in the memo line in my QuickBooks file what it is. And then also we have, for office supplies, I write in coffee and paper towels really quickly in the memo line so I can easily find those receipts if I need them. So speaking of gifts, our next slide talks about gifting. As a reminder, this isn't anything new. You can only write off $25 per person per gift per year. So if you're a real estate agent and you close a great sale up in Duluth and your commission's $30,000 and you want to get the couple a $1,000 gift basket to say thank you for doing business with you, legally, according to the IRS, you can only write off $25 per person per year. So a total of $50 for that $1,000 gift basket. So what that looks like on your QuickBooks file, it would be, let's say you ordered it from Amazon, it would be $1,000 charge, $50 would be a gift, and the other $950 would be a non-deductible expense. We would see that on your profit and loss, and so we'd be able to pick that up and not take that on the tax return. So there are gifting limits to clients and team members. Last one we're going to talk about is W-2 owner salary. This is really, really important that owners are taking fair and reasonable compensation. If you're a doctor making $500,000 a year, $12,000 W-2 is not fair and reasonable. We can help you through this calculation and let you know what fair and reasonable is if you contact our office. What we can say is if we're going through an audit and you've taken half of your profits out in draws and the other half out in W-2 wages, that's usually a pretty good argument for us not to be audited on that item. So fair and reasonable. And if you're operating at a loss on your tax return, you do not have to take W-2 wages. But it is important if you're operating at a profit to go on a W-2 and take wages. Now we're letting our clients know at the beginning of the year, we're no longer going to have access to Karma Payroll. So I'm no longer an owner in Karma Payroll. We have a new partnership together with Meridian Payroll. There's a division that links up with Elite Tax Partners, and we have full access for our clients. So more to come on that. We'll be moving our current clients over to Meridian Payroll at the beginning of the new year if they're not there already. All right, well, Kelly talked about all the things we can't write off. So let's talk about what we can write off. We have, and I think Kelly's going to share that in the chat with you guys, a download of income and expenses. We call this, as nerdy accountants, our chart of accounts. These are typical expenses that most business owners have. As Kelly shared with you, there's nowhere that you can go on the IRS website and download a list for real estate agents that are common deductions. It just says ordinary and necessary. So we wanted to provide you with something that you can have in your pocket. Of course, you'll probably have a lot more expenses than what we're giving you. But this is something to get you started of what you can write off. Next, we're going to talk about how to save your receipts. A lot of business owners don't know or don't understand that you have to save your receipts. For instance, if you go to Walmart and you have that Walmart charge on your credit card statement, the Walmart charge isn't anything that the IRS agent is going to allow if you don't have a receipt, because they don't know if you're getting underwear, socks, or groceries there. You could have been buying paper for your business, but without that receipt that shows the paper cost, they're not going to allow it. So receipts, you have to keep them. So what I do is you can get an accordion file, or if you have more receipts, we go through a lot of paper here at Elite, even though we're paperless. Some clients still love paper. So I get one of the paper boxes at the beginning of the year. I put my files in there and I label them. I go back to that chart of accounts to help me think about my labels. But for me, it's going to be fuel expenses, auto repairs, cell phone, utility bills, meals, employee appreciation events. We try and do a lot of those here at Elite because our employees are rock stars. So what I do is I create this file once a week. Wendy up front goes through the receipts and she puts them in the appropriate files that they need to go in. I never look at them. I audit everything through reconciling our bank statements. And then at the end of the year, December 31st, we put a lid on that box. I write 2022 on it. I throw it up in my attic and I start a brand new one for 2023. That's how I save all my receipts. Like Kelly said, your calendar is your Bible. If you go into an audit, that is going to be really, really important. And so in that calendar, I'm also documenting who I ate with, why it's necessary, what we talked about. I have the receipt up in my attic. And on the calendar, you'll see, and then I also have my bank statement, which you'll see the exact charge of where we ate and how much it cost. And so a lot of clients ask, how long should you keep your tax returns? Tax returns, I keep them all the time. I don't throw away any tax returns. We're paperless now, so a lot of you have your tax returns on our client portal that will stay there forever. But for your tax returns, those are important in case you ever have a discrepancy with Social Security office to have those. But receipts, you have to keep them for 4 years. After 4 years, you can shred them. But if you haven't had good documentation in the past and the IRS audits you, they're auditing 2019 right now. If they audit you for 2019 and see a lot of holes in it, like Kelly said, they can go back several years. So keep that in mind as well if you haven't been good on your documentation. All right, separation of bank accounts, another thing that our clients aren't great at. And so again, we're crossing those T's and dotting our I's and just doing things by the book starting now. And so commingling of funds is a no. The IRS hates that. We're going to create 2 separate bank accounts, one a business bank account and your personal bank account. Things that aren't going to be in your corporate bank account, your business bank account, are your Nordstrom's rack receipts, your Lululemon, your football game tickets. Those aren't a write-off on the business. Those are personal expenses. And so what you want to do is you want to transfer money owner's profit or owner's distribution over to your personal account. You're also taking your W-2 wages, so that's another way to get money in your personal account. And in your personal account is where you're going to buy groceries, your jewelry, your shoes, your uniforms, your clothing. I know my business owners think that it's uniforms, but this is not a uniform. I cannot write off this outfit. It does not have my company logo on it, and the IRS looks at it as I can wear it anywhere. And so that is not a write-off for you. Real estate agents getting your hair and nails done and your eyelash extensions, that is not a write-off. I agree, part of selling is looking great and playing the part, but the IRS doesn't agree with that. So those are personal expenses, not a business write-off. So don't commingle. Another reason why we don't like commingling is if we ever do go into an IRS audit, and I like to knock on wood because I hope that that doesn't happen. It stinks, but we shouldn't fear it. We should take the expenses that we are entitled to. If you ever go into an IRS audit, it is really important that we're not showing them the entire world. We're answering only the questions and only giving proof of what they've asked for. If you've commingled, they're seeing everything, and now we have more questions and more time involved in the audits. And they know a lot more, and we don't want it that way. Okay, so how do you track all this stuff? Many of you know we like QuickBooks. Most of our business owners, about 90% of them, are on QuickBooks. If you have never tracked before, we believe that QuickBooks Online is going to be the best solution for you. I like QuickBooks Desktop, but I've been doing it for 22 years, and that's what I learned on. But QuickBooks Online is great for someone starting new. We recommend QuickBooks Essentials. So there's a cheap version called Self-Employment. That one's crap. Don't buy that one. Buy the Essentials one. And you should be doing your bookkeeping on a monthly basis. You shouldn't wait until January 30th because you have an appointment with me on February 15th. We don't do that. It is important to look at trends also with tax planning. We need to know those numbers moving forward to make good recommendations. And if you don't know how something should be entered that we're talking about, Kelly and I are here to help. Send us an email. Hey, this is what I have going on. Is this a write-off and how do I enter it in QuickBooks? We'll be more than happy to answer those questions. If you're our client, we don't nickel and dime for those questions. That's what you pay us for when you hire us to prepare your taxes. We'd rather you ask the question now instead of come tax time and we're trying to unravel everything from last year. Now, if you don't want to do this yourself, we have an amazing bookkeeping team headed by Biff. Biff, our bookkeeper. He is our QuickBooks guru, and he can take that all off your plate and handle everything for you. So we do offer bookkeeping here at Elite. On average, our clients pay about $350 a month for bookkeeping. So reach out to us if you have any questions on that. And with that, I'm going to turn it back over to Kelly for tax planning tips.
So I think the most important tax planning tip there is preparing ahead of time. You know, taxes should not be a one-time-a-year event. If we're only seeing you once a year to do your tax return, you're not getting the biggest benefit out of your relationship with us. So booking a tax planning appointment allows us to go through your profit and loss statement. We can start looking at if there are questions on there, if anything needs to be cleaned up in advance of your actual tax appointment. We can also talk about what your tax return is going to look like, so you can prepare ahead of time. We could talk about ways to change that outcome, because if you wait until March to come in, the tax year ended December 31st, and there are very few things that we can change after that fact to give you a better outcome. Now, if you haven't booked a tax planning appointment, we would urge you to email us at admin@elitetexpartners.com. And let us know you want to schedule one for the next couple months so that we can get you taken care of. Now, something else that I want you to stop and reconsider is your donations. So businesses, a lot of businesses are solicited for donations frequently. When you make a donation and code it as a donation on your QuickBooks file, then that actually passes through to your personal tax return. Donations are not deductible for a business. So take a minute and think about what you have donated this year. And if there might be a different expense category, we can put that in. So frequently businesses donate in return for some kind of advertisement. So, if your children play baseball, you might get a banner on the backstop that is there every day for every baseball game for the entire season. So that's not a donation anymore. That's an advertising cost. If you're getting an ad in a program for, a benefit or a theater event, then that's really advertising. So make sure that you're taking a careful look at what you are donating and getting the best benefit out of it. Being able to write it off directly against your big business income is going to be a better use of it than having it pass to your personal return. Along those lines, we also like to talk about income timing. So if your business is pretty busy in December, or you have a big project that comes in and you will know that your profit is already high for the year, it might be worth talking to your client and asking, hey, can you hold off till January 1st to mail me that check or make that payment online? So now it puts that income into the next year. So then we have more time to plan strategies to offset that income. Now, another strategy that's similar is prepaying your expenses. So if you have a commercial space that you rent, you could pay a couple months of rent ahead of time. And now you get that deduction now, bringing your taxable income down for this year. You can look at, what your equipment needs are for your business. Is there something that you're going to need to purchase in January or February and you already have the cash set aside? Let's go ahead and buy that piece of equipment now so you can take the tax benefit now. And then it gives you more time to plan for the next year and find more strategies to put into place. Something to keep in mind, our average client is in the 32% tax bracket between federal and state taxes. So if you are able to decrease your business income by $10,000, that saves you $3,200 in taxes. So it can have a pretty good impact if you plan correctly. Now, another thing that we talk to our clients about is putting their kids on payroll. Kids are expensive. I'm sure you all know that, especially those of you who have a few. By putting your kids on payroll, you're shifting income to a lower taxpayer. So if your children are paid $12,000 or less, they're going to be in the 0% tax bracket. They are not going to owe any taxes on that income. You're going to get a deduction for $12,000 and lower your tax liability. And then we'll talk about how that benefits you in the end by having them starting to pay their own bills. So in order to put your kids on payroll, you need to have a job description for them. That job description needs to be appropriate to what your business is and what the child's age is. So you can't say that you have your 2-year-old cleaning your office. We all know that's not really happening. You need to keep track of the hours that they're spending. I do urge our business owners to find a way to have your kids be involved in your business. It is paying their living expenses and making the family home comfortable. So if they can invest a little time in that, I think that's important as well. Now, the money that they earn does belong to the child. It has to be deposited into that child's bank account. And then they can use that to pay the expenses that you were paying before. So they can pay their club soccer tournament fees and their dues and their practice fees with that money. They can buy their school clothes. They can pay for their school lunches. They can pay their portion of the cell phone bill. They can use that to save for college, save for a car. You can also open a Roth IRA for them. Rob here in our office is going to speak in a few minutes. He would be a good resource for help with that. And if you do want to put your kids on payroll, or if you haven't put yourself on payroll yet, then we can get you in contact with Meridian so that they can help you through that process. Another benefit as a business owner is that you can get credit for paying your own health insurance. There are a few requirements around that, and I can tell you that most of the people that are writing it off currently, it's not being done in the best way. So it is an audit risk if you're not doing it correctly. So this is going to have to involve your payroll company. Some of the rules around this are that you can't qualify for health insurance through like a spouse's job or somewhere else. You have to be buying your own insurance. That insurance premium cost is going to get added to your taxable wages on your W-2. So that increases the wage expense that your business is writing off. Now that W-2 income is going to show up on your personal return, and then we're going to deduct the self-employment cost on that side. So your business gets a benefit and you're paying tax only on the actual wages that you took. This benefit actually extends to some of your family members as well because of the way that the IRS has set up their deemed ownership rules, they call it. So if you employ an adult child, a grandchild, your parents, your spouse, all of these people can benefit from the self-employed health insurance deduction. If you need any more clarification or need to talk through that, that's a good topic for a strategy appointment as well. And now we're going to head back to Nicole for some more tax planning tips.
Excellent. Thank you, Kelly. I'm going to kick it off with something brand new and very exciting. It's called the pass-through entity tax. We call it PTE. And so if you've been coming in for your tax planning appointments and opened up our emails, you would have saw an email from us talking about this pass-through entity tax. So back in before 2018, you were able to write off your state income tax that you paid. So for example, if you owed California $12,000 and you had $4,000 of property taxes, you were able to write off the $12,000 plus the $4,000 for a total of $16,000 off your federal tax return. Well, in 2018, the Tax Act came out and it no longer allowed, it capped it at $10,000. That's what you heard a lot around the news about the SALT cap, that you can only write off $10,000. Well, for a lot of people, your property taxes and what you pay DMV fees is close to $10,000. Now you don't get to write off your state income taxes anymore on your federal return. Well, California came out with something and the federal government is allowing it to write off what you owe the state of California through your corporate tax return. So it gets kind of tricky with the timing and everything like that. If you met with us already, you already heard about this and you already took the steps that you needed to write it off for 2022. But this is something we can still write off for 2023, and as long as they're going to allow us to do it. So if you haven't heard about the pass-through entity tax, it's a way for you to write off California state income taxes that you have to pay and get a deduction. So as Kelly said, if you owed California $10,000, our average client is in the 32% tax bracket, you would save $3,200 on your tax return by doing this. Next, we're going to talk about our home office reimbursement. So this is for corporate owners that actually have a home office in their home. So at Elite, I start my day very early at home. I start at 5 a.m. on a Zoom mastermind call with people around the country. And then I pay my bills, the corporate bills at Elite home, at my personal home office. So the home office reimbursement is what we take advantage of here at Elite. And what it does is Elite pays me personally, because I'm an employee of Elite, a home office reimbursement. I call it office space on my profit and loss. And it allows Elite to pay my home office at home. It allows me to get that money and I don't have to pay personally on that money. So this is different. We're now doing it different. Tax law changes every year. This is a better way of doing it than we've done it in the past. So this is new home office reimbursement instead of the rent that we were charging from before. And so on the next slide, we're going to show you our home office reimbursement. And Kelly also is going to put in the chat the download form of this so you can keep track of this. And with that, I'm going to pause. If you have any questions as we're going along, please ask them in the Q&A down at the bottom of your bar. And at the end, after Rob speaks, we're going to open it up to our questions and make sure that we answer all of them. That's going to be important. So home office, what can I deduct? So monthly, you're going to pay attention. You're going to keep your utility receipts, your landscaping, your homeowners. Usually that's paid through your mortgage. So a copy of your mortgage statements, internet, all of that stuff. You're going to make a sheet of all those expenses, save all the receipts, and then you're going to submit this form to your corporation, and your corporation is going to cut you a check on the percentage that you're running your home office. So for quick math, we'll say my house is 1,000 square feet and my home office is 100 square feet. Therefore, I would fill this form out 100% of what it actually is for my house. And I would be reimbursed from the corporation of 10% of what this total was, if those were my numbers. If you need help with this or need more information, please reach out. This is different from what we've done in the past. All right, next we're going to talk about the Augusta rule. The Augusta rule came out with the Masters Golf Tournament. And what it said was that for those 14 days that kind of Augusta, Georgia goes crazy, people would get out of town and they'd rent their house out for people coming into town to watch the tournament. The IRS came out and created something in their code that said you do not have to pay income on rent received on your home if it's 14 days or less throughout the year. And so a strategy could be maybe having a holiday party at your house for your team and reimbursing you. And that would be a way to get tax-free income out of your corporation to your personal account. This is a great strategy that can often put thousands of dollars in our taxpayers' pockets. So if you're interested in this, reach out to us for more information on the Augusta rule. This is different than the home office reimbursement, and you can do both of these strategies. All right, what do we have next? Oh, this is a fun one. There's a new disabled access credit that's available that most taxpayers don't know about. So this is important if you have a website. Right now, there are law firms that are coming after business owners that don't have an ADA compliant website. Most people don't even know that you're supposed to have this. There's the ability to make your font larger, adjust the color, captions, listening to what's being read on the website. There's a large cost for this. We just paid our website designer $2,500 to redo our website to make it ADA compliant. So one, as a business owner having a website, you should know that it should be ADA compliant. Two, a lot of our restaurants and stuff had to make special accommodations when the Disability Act came out. And you should know that you get a credit for these. So if you do $1 million or less in gross revenue, if you have fewer than 30 full-time employees, up to 50% of the expenses that you're paying for your business, to do these, you could get a possible tax credit all the way up to $10,000. And so for us, that $2,500 is going to put a tax credit in our pocket of $1,250. A tax credit is different than a tax deduction. A tax deduction is what we've been talking about: a home office reimbursement, kids on payroll, health insurance premiums being paid for self-employment individuals. Those are all tax deductions, and you get a percentage, whatever tax bracket you're in, off your tax bill. A tax credit is way better. A tax credit is actual dollars in your pocket. So by spending $2,500, I get to write that off and get a tax deduction, but I also get $1,250 tax credit dollars off my tax bill as well. All right. So this is a tip that we like to give a lot of our business owners. A lot of times we make decisions on spending based on what's in our corporate bank account. So maybe you have $100,000 sitting in your corporate bank account, but you haven't paid any of your estimated taxes. And it's the end of the year and you decide, because you have $100,000 to spend, you're going to have a bomb Christmas party that's going to cost $10,000. You're going to bring out all the bells and whistles because you have $100,000 to spend, right? Well, no, because you haven't paid your income taxes. And your income taxes, if you're profitable about $400,000 that year, could be as high as $60,000. So you're making decisions on $100,000 when really you should only be making decisions off of $40,000. Chances are you're not going to have that $10,000 Christmas party if you only have $40,000 in your corporate bank account. So what we like to advise is creating an extra savings account where you're portioning off income each month. We like to do it twice a month into this savings account. We call it our tax savings account. Now I'm speaking to a large group of people. And so what I like to say, if I had to pick a number, 15%. you should be saving 15% of every check that comes in. And we like to move that money out twice a month on the 1st and the 15th out to that tax savings account. Now, your percentage could be a lot greater or a lot lower if you work with us and do active tax planning. So we can give you that exact dollar amount based on last year numbers and some rough planning for this year, so that come tax time, you have that money set aside and you're also making decisions based on what you actually have to spend and not the greater of the number because you haven't paid your income taxes yet. So this strategy comes from a great book. We highly recommend it, called Profit First. It is, if anyone's ever gone through Dave Ramsey's Financial Peace University, he talks about the cash envelope system for controlling your monthly expenses. So you pull out cash from an ATM machine for your fuel, your groceries, your gifts, things like that on a personal level. And you use those cash envelopes. When your envelope is empty, you're done spending for that month, or you have to borrow from another envelope. Profit First takes the same type of strategy and implements it for your business. But in business, we don't use cash because the IRS does not love cash receipts unless we're claiming cash as our income. So we use bank accounts to account for these different type of expenses. It helps us control and budget. So Profit First, fantastic book. We are also Profit First certified firm. So if you want more information, start with the book. The audio book is great because he gives a lot of examples in that audio book. And so that's highly, highly recommended. Okay, talking fast here. We're trying to get you guys out. We said 7:30, but we like to end early if there's not a ton of questions. You guys should have a lot of questions though. So I'm excited to see those when we're done. I'm going to now introduce to you Rob. Rob joined our firm a few years ago at Elite Tax Partners, and he came to us with over 15 years of investment experience. Rob's interest in investments is rooted in his desire to help ordinary people make smart decisions and look forward to retirement instead of stressing about it. Rob is focused on fully understanding each of his clients' unique circumstances and giving advice in plain language. Boy, we love that, Rob. He holds his chartered financial analyst, that's huge, that's a huge degree, and his certified financial planner designations. And with that, Rob, we will kick it off to you.
Thank you, Nicole, for that warm welcome there. So basically, I'm going to keep it brief. Thank you for hanging in there with us. And I only have 2 slides, so it's not going to be too much here. So to start off, basically, I am the investment arm of Elite Tax Partners, and Elite Tax Partners is primarily business owner oriented. However, all of Elite Tax Partners clients, we will also do individual and family investment planning for them. That's really where it all starts, the planning phase. Try to gather as much information about your particular situation and develop an investment plan based on that. We really want to make sure that you have the appropriate amount of risk in your portfolio and that you're able to focus on generating the type of retirement income that you need later in life. All right. Oops. There we go. So for organizations and institutions, we provide retirement plans for corporations, small business, and of course, self-employed individuals. Our firm acts as a fiduciary. And what that means is we step in and fill the gap between your retirement plan and regulatory scrutiny. So in essence, we can never fully insulate you from litigation, but there's a big help in designating a fiduciary to handle things on your behalf to make sure you're in compliance with all the necessary laws out there. We also offer investment advisory services with regard to these institutional retirement plans. Once you save the money, we want to make sure you're investing those assets in the most effective way. All right, moving on to the next one. So with retirement plans, there's many different types of retirement plans, IRA, simple IRA, but sort of the grand poobah of retirement plans is the 401k. All right, so with the 401k, and this is very important, and we'll talk a little bit more about the Cal Savers mandate in a few moments, but if you're looking to increase the amount of deductions that you have, as Nicole has alluded to, 401k is a great way to do that. You can, as an employee of your firm, you're an owner, but you're also an employee if you're paying yourself a wage, which again, as Nicole had said, you have to pay yourself a reasonable wage. So as part of the 401k, you can deduct $20,500 from your income and put it into the 401k. So the 401k only. If that's good enough for you, you stop there. If you're looking for additional levels of deduction, you can now tack on a profit sharing plan as part of the 401k. This is an employer contribution to the retirement, to the 401k plan in the form of profit sharing. So that will boost your ability to shelter income all the way up to $61,000. Again, you have to work with your accountant to make sure you can get that higher threshold, but you can get up to $61,000. If you're over age 50, that amount goes up a little bit to $67,500. And so that's another sort of stopping point. If that's good enough and you're good with that amount of deduction, you stop there. However, there are some business owners that have a really high level of income that's sustainable and regular throughout their careers. And if that is the case, you can add a cash balance plan, which is a type of defined benefit plan, to the 401k, and you can significantly increase the amount that you can reduce your income by or deduct from your income. So it's all based on age. There's other factors. One of those is the makeup of your workforce. So we can really get into the weeds on this, but the thing you want to focus on is the older you are, the higher the availability to shelter income. So if you look at the chart, if you're 60 years old, you can do considerably more of a income reduction than you can at 40. Okay. So does a cash balance make sense for you and your company? Again, we cover the things, but the main things you want to keep in mind are you looking for substantial tax deferrals? Okay, if that's the case, you want to reach out. Do you have stable levels of high income, and are you over age 45? Those are the things you want to keep in mind when considering a cash balance plan. And to kind of loop it back to Cal Savers, we had a question come in, and we have a client that has 3 employees. However, it's a husband and wife that own the business. If the business owners are paying themselves a W-2 wage, they do count as employees for the Cal Savers mandate, which went into effect in June of this year. So if that's the case, then you do fall under that requirement, and you either have to set the framework up for Cal Savers for your employees, or you can opt for a different retirement plan, whether that be a simple, whether that be a 401k. So if you have questions about this and you want to find out a little bit more information about how to set up the right retirement plan for you, please reach out. And that's all I have. Thank you so much for your time, and thanks for jumping on the webinar.
Excellent. Rob, can you advance that last slide? We are going to open it up to questions now. So if you have a question that you haven't answered yet, at the bottom of your toolbar on the Q&A, there are the questions. Also, you can email us privately as well if it's very specific and you don't want to ask it. But it's only barely almost 7 o'clock, so we have time. So our first question comes in: are credit card statements sufficient to replace paper receipts? And no, they are not. The IRS wants to see, even if it's Verizon, one can assume that's for your internet and cell phone plan, but a lot of clients also have their cable, their very expensive cable bundled in there. They have their kids who aren't employees that are on that cell phone plan. So the IRS wants to see these receipts, especially if it's something like Target, Walmart, things like that. They'll definitely want to see the actual receipts. Your
Amazon, like we talked about earlier, your Amazon purchases, we definitely need to be able to see the details.
Yes. Your accountant, we don't want to see the receipts, but you want to save them in that box, put them up in your attic just in case for an audit. So I have another client that's writing in for a $25 client gift. Branding something such as a Cutco knife with a name engraved is completely deductible if that was $175. Yes, because that's not a gift now, that is marketing because your logo is on it, your company logo's on it. So on your profit and loss statement in QuickBooks, you would title that as marketing and not a gift. So that is an important distinction, and you are correct. That is entirely deductible. If you put logos on it, now you've changed it. Thank you for pointing that out, to a marketing expense, much like Kelly was talking about trying to change donation. Is that marketing? Because we want to take the marketing write-off more. Okay. So we have someone writing in, what do you recommend if someone has not been tracking mileage properly to mitigate damage? I would say probably 90% of clients are in this exact same boat. We've gone into an audit before without proper mileage logs. So what we usually recommend is start today tracking your mileage. And then if you ever do get called to an audit, we can we want to be truthful. We want to let the IRS agent know that the client did know that they're supposed to be tracking mileage. We look to get your legal repair bills from your car repair maintenance guy, and those usually have your beginning mileage on those. And so we like to find one in the beginning of the year and at the end of the year. And then we can say, okay, client started with 10,000 miles, ended the year with 20,000 miles. They drove 10,000 miles. Now we have a legal document that says how many miles you drove. In addition to that, now you are tracking mileage, even though it is in the year 2020. Gosh, what year are we in? 2022. We have a history of mileage. And so we've been able to go back and say they didn't know that they were supposed to track mileage in 19. However, in 2022, you can see they drove about 12,000 miles and 8,000 of them were for business. If we take that same type of percentage, because business is equally, about equal as it was to 2019, and we can come up with something there. And so it's not the end of the world. You just start getting better now and start tracking it now. Is a medical sharing able to deduct like a health insurance? If so, does the business pay for it? Does it come out of a personal account? So that is a great question. There are a lot of different ways of doing that. It depends on what type of entity you are in. If you can have something called a health arrangement where the business can deduct some health costs, but most of our clients do not qualify for that. What most of our clients do qualify for, if their health insurance is HSA certified plan, and so you look at your health insurance, and right now it's open enrollment, so maybe you switch to a health savings account, an HSA certified plan. What that allows you to do is it allows you to open up a personal savings account for your healthcare costs, for your co-payments, your prescriptions. I think it even now covers over-the-counter CVS items. Kelly can talk to that in a minute. But a family can save $7,300 in that health savings account a year. And if you use it all, great. But if you don't use any of it, we still get to deduct the $7,300 if you use it or not. So that is a great benefit. Usually we recommend setting up a health savings account for those out-of-pocket co-payments because most people can't deduct those. Health savings account gives you the ability to deduct those. Kelly, do you have anything to add to that?
Along the lines of what you were saying, so over-the-counter medicine, you can deduct your feminine hygiene supplies. Those are allowed as well. Physical therapy, anything along the lines of those, you're able to take advantage of that health savings account. And with the health savings account, it's not a use or lose kind of an account. So you can put your family maximum in, you can put in $7,200 a year, and you can use that to save for future years. So especially as you get older into your retirement years and your medical costs normally go up, whatever is in there stays there until you use it. So it is a good way to save for future medical expenses as well.
So I do want to circle back around to that question because they talked about kind of the commingling. So we do want to make sure that no matter what, most companies don't qualify for a health arrangement account. So we're going to pretend like in the world, and I know what clients are on here. So for medical co-payments and mileage to medical doctor appointments, prescriptions, things like that, counseling sessions, all of those are personal medical expenses. You do not write those out of the corporation. And so you'll open up well, you don't have to, but if you wanted tax savings on that, you would open up a HSA, a health savings account, and then you would be able to write them off personally. But these are all personal expenses. It's not to be commingled with the business. The business is not supposed to be writing any co-payments or prescriptions or counseling sessions. So we have another client asking if the S corporation can pay for mental health therapy for the owners. And no, unless the owners have a health savings account, then the owners can write that off and get a write-off for their mental health therapy. But if we're talking about something like there's multiple owners and employees and you're taking them, we have a mental health day, that's April 16th. As long as the government allows us to be off on April 16th and doesn't extend tax season, we actually go to a spa and a resort and celebrate a job well done, working really hard. For us, that's a mental health day, and it's also a team building day, and we are able to write that off from the S corporation. It's not entertainment, it's team building because I take the entire team. So Rob, we have a question here for you for Cal Savers requirement. Are owners of an S Corp counted towards the 5-employee rule?
Yeah, so I think we kind of went over this a little bit, but if you are drawing a W-2 wage, even if it's an S Corp, that would include you as part of the employee pool, and you would be subject to the Cal Savers mandate. That is my understanding.
Excellent. We have another client asking, do you recommend a high deductible health insurance plan as well as an HSA? So this is different for everyone depending on your healthcare needs. And so you need to sit down and kind of weigh in on these. If you have if you're going to the doctor a lot, you have a lot of prescriptions, you have health issues, a high deductible health plan might not work for you guys. For me personally, I don't go, thank you, God, I'm blessed, and I don't go to the doctor except for chiropractic and holistic. So for me, I don't have high healthcare costs. I do have a high deductible healthcare insurance plan, and I use my health savings account, my HSA, to save that, because it's a family plan, $7,300 away. And so if I ever do, God forbid, go snowboarding and break my leg, and I have, a $50,000 medical insurance or medical bill, I can use my medical insurance would pick up most of it, but I'd have about a $7,000 out-of-pocket cost before my insurance would kick in because I have a high deductible cost. So I'd use my savings account that I have sitting over here to pay for that deductible. So for me, the high deductible health insurance plan works with an HSA. But for some people, when they do the math, it does not work. So everyone is different in doing the math. Typically, I find that if you're really healthy and don't go to the doctor, the high deductible health insurance plan with the HSA, as long as you're saving for that if it happens day, that usually works best. So another question, can you use your health savings account for a holistic doctor? And yes, you can. I use mine for Casoni Wellness and get acupuncture there. This is a great question. Can a fitness club dues be paid with an HSA? Now, Kelly, correct me if I'm wrong. No, you're saying no. Not even if a doctor says you're overweight and you need to work out?
That's very borderline. So if you can get a letter from the doctor, then yes. And any kind of physical therapy, yes. There are some physical therapy clinics out there now that are running weight loss programs as part of their therapy. So that might be an easier route, but as long as you have a letter from a doctor, and I would say you probably need to update that on a yearly basis. So if your letter is from 10 years ago, it's not going to work.
And we do also have a fantastic health insurance partner. It seems like we're getting a lot of health questions. So if you have any questions, really specific questions, we can refer you to a really great provider.
Yes, thank you, Rob. I have another question. It's a cute question. What if my job requires me to lift heavy items? Can I deduct my health club dues? And the answer is still no.
No.
All right, guys, is there anything else? We'll wait just a minute. Below is our email address to get a hold of us, our phone number to contact us. Please reach out if you have any questions or you didn't feel comfortable asking a question on the live Q&As. That's what we're here for. Appreciate your time and spending this Thursday evening with us. And look at that. We ended 25 minutes early. Thank you guys for joining in and becoming more educated. You are better clients for us for being more educated. So we thank you. And we will see you very soon.
Thanks, everybody.
Bye, guys.
Thank you all.